Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
We're chatting with Bob Hoye, market historian and chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. And I always say, here's Friday, and we've got markets to talk about.
Taking a look, you said there's a triple combination that caught your eye. What is the big triple combo?
Some headlines here. Gathered them up the other day, and one of them, actually this is dates from January, but it's part of the story. And the headline is, Lacking Pipelines, New England awaits its first ever shipment of Russian natural gas. And they're not using American natural gas because some people don't like pipelines. So then we've got another one from April down in Texas, and here it is. Oil producers are flaring enough waste gas to power every home in Texas. And the story there is you've got crude oil production with pipelines for that, but they don't have a pipeline for the natural gas that accompanies some oil field production, so then they just have stacks and burn it. So they're burning enough waste gas to power every home in Texas because the people in New England don't want to have a pipeline. I mean, I can't believe it. So at any rate, and then there's one with a little hope here that Trump signs an executive order to fast-track oil and gas pipelines, and that's a positive step, whereas when Trudeau came into office in Canada, the previous government under Harper had set up the reviewing process for new pipelines to make it as simple and straightforward as possible. And then, of course, Trudeau came in, and really the variations he did were to make it virtually impossible to add new pipelines. So it's a period of political insanity, Jim, but I think it's like a financial market, in something like whether it was like gold and silver in 2011 or crude oil in 2008. There's sort of a madness that comes into a rising price and reinforces that, and as we always say, they sort of go from parabolic to hyperbolic. Well, I think you can get the same thing in political activity. They just get more and more hyper, and when you stand back and look at it, you can say, in the financial markets, something going straight up is ending action. You're not sure exactly when it's going to end, but you can recognize the condition of ending action. And, of course, this is what you've got going on with politics, and particularly in the U.S. With three recent Congress people for the Democrats who are absolutely stark raving mad. And then now this week you've had the socialist mayor of New York City come out and say that New York is going to be meat-free in order to save the planet. I mean, and he's worried about ocean levels rising when the actual rise in sea levels has been a consistent minuscule amount. The activists are worried about rising CO2 concentrations in the atmosphere when actually, we're geologically speaking, even at 400 parts per million is relatively low. And the rise in CO2 concentrations is very good for plant life, and that's very good for all kinds of other life as well. They're very upset that a warming trend is bad. Throughout all the history, the migrations and die-offs have been caused by remarkably colder trends. They're worried about increasing tornadoes and storms. The U.S. is the tornado capital of the world, and the frequency of severe tornadoes has been diminishing for the last 50 years. So they live in a world that is unreal, and that's fine. That's a private and personal choice. But the problem is that they have to inflict their unreal superstitions upon the rest of the world, and I'm getting tired of it.
Well, I saw a report that said Canada's GDP increased by 32% because of warming, because if ice caps retreat and glaciers, which they have, it reveals more natural resources for us to exploit. And so they said no other country has benefited more from climate change than any other country than Canada.
Yes. You got to realize the last ice age, at the maximum, the ice was, even in flat places, was at least 2 miles thick. And it gets that thick, and then it becomes a sort of a slow-moving plastic characteristic in it, and then it just all heads south. And the ice extended down as far south as Chicago.
Yes, Vancouver was under a mile of ice. Would you rather have that? And also, nothing has shaped the Earth more than ice. If you watch BBC Earth while sitting in the dentist chair like I just did the other day, you learn a tremendous amount. We should be very glad that we live in a period of warmth, because usually the planet's 100,000 years of ice and 10,000 years of warm. Well, we're at 10,000 years, so we're actually probably at the tail end of this warm period.
Yeah, well, the sun, to about 20 years ago, was on an activist. It was becoming more and more active. And it reached, exceptional. I think the most active it had been in thousands of years anyways. And of course that has been associated with warming trends and low periods, quiet periods for the sun associated with cooling trends. Been that way for a long time. And the sunspot count, which is kept track of, is now the solar cycle 23, which was the last one, solar cycle 24. They have been the weakest since the early 1900s. And this decline in solar activity is a built-in cooling trend. And of course, you've got lots of inertia out there with the oceans and whatnot, but we on this, and also the sun is the main driver of climate change anyways. CO2 has absolutely nothing to do with the actual changes in climate trends. So, we've had the good times, and if it really is onto a lengthy cooling trend, future generations will notice it. But what will also be noticed is the absolute nonsense in the hysteria behind this, and this is where I'm saying that the action in this crazy, hysterical political action is quite likely burning itself out, and financial markets may be getting a little excited as well.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, taking a look at the action on the markets this week, kind of a mixed board to finish off, but record highs continue to be set on the equity markets. Is that trend going to continue?
I don't think so. Yeah, the senior indexes, S&P, NASDAQ, Dow Jones, have made higher highs than recorded last year. The one I follow, the New York Stock Exchange Composite, it's about 1,500 stocks. It is not making new highs, but the main thing is that you've got some very good technical readings. You've got momentum, and you got pattern, you got sentiment figures, and of course you're still at extremely high valuations, whether you want to compare it to earnings or wages or relative to gold, anything. They're high valuations. But our work was last, I think it was December 26th we put it out, where the plunge in the stock market and the plunge in crude oil had come down to downside exhaustion, downside capitulations, these excesses. And then you were going to get a rebound out of that. And then our target was using seasonal work somewhere around March, and that would be a rebound for base metals, which we did get. It would be an improvement in credit spreads, which is still going on. The other one would be an improvement, a friendly trend in the yield curve. Now that's beginning to change. There's a warning up on the yield curve. And then also a few weeks ago, we figured, well, maybe the seasonal on crude could run into late April, early May. And yes, it's been friendly. So base metals, they haven't been negative, but they haven't been friendly for 5 weeks. And crude oil has been very friendly until just the last couple of days, and it looks like the correction we've been looking for has started. And that then, of course, will have an effect. Then credit spreads and, all that sort of stuff. So the other thing is the action in the oil stocks also overdone and are starting to roll over. So I think we're going to get a good correction in crude oil and the oil stocks. This is going to set the whole market back and, as I say, also do credit spreads. So the things we were looking for to run into around March of the good stuff came in and has been very good. And it looks like a few of the games are starting to change. So at the moment we can call it a correction. And then the other thing is, Jim, with these seasonals, that the old sell in May and go away, it's there. It's for decades, hundreds of years. So what you want to have is two things, a good grasp of seasonal forces, and the other one is really good technical research that can give you, as at Christmas time, the oversold, and as recently, the overbought. And it makes a very good guide for investing. So on this seasonal basis, and we've got joy now when it was possible, we're going to get a correction. And then the next thing to look at is that oftentimes after mid-year, credit spreads can turn to widening and the yield curve can turn to negative. And then you start looking at the seasonal lows for base metals, which can, if we look at copper, that can be November or December. And you look at crude oil, and that can be December or January. You look at lumber, and the low can be low seasonally in October, and that one worked very well for us last year. And here recently, you had a terrific rebound for lumber out of dismal conditions in October, and then now it's almost back to the low of October. And then I was just looking at a chart here this morning that big turns in lumber price lead turns in home builders stock index in the U.S. So, hey, we've got a very good GDP report in the States. It's now in the markets. And what we want to do is look beyond current news and watch for hazards out there, because the financial markets are overpriced, even including the bond market. So we've done a big study on that those interested in fixed income should know about. I mean, this is a major historical study, and it paints a picture that the credit markets after mid-year are not going to be too friendly. So
we can talk more about that, Bob.
Indeed we will.
Right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, none of us is getting any younger. And yes, retirement for many people. They're already there. For others approaching it. What does the bond market tell them, and where should they be making sure their money is to make sure they don't run out of dough as our extended lifespans become even more extended?
Oh, yeah, good point. The fixed income markets don't get really as much press as the stock market does, but they're even more important. Now, there's been a rage to buy junk bonds. I mean, people have been reaching for yield around the world. It's a global phenomenon, and that shows that there's a great deal of confidence out there because risk is being overlooked, but it never ever goes away. So we would be coming out of low-grade stuff, high-yield stuff. It's painful to give up yield, but then if you go to straight cash, like T-bills or bank deposits, those interest rates may go down, where interest rate for junk may go up as the price goes down. So you want to find a nice place to park, and that would be in high-grade corporate bonds, which then has minimal risk. But then if you buy the longer-dated maturities, you're going to be at term risk. So what you want to do is buy around the 4-year maturity of good corporate bonds. And in Canada, you would want to buy U.S. corporate bonds because you'd get a play as the U.S. dollar continues to go up. So one has to look after one's fixed income portfolio. They can be deadly from time to time. So that's our advice. Actually, for equity people, if you're coming out of equities and building a little liquidity in case there's a storm, again, if you put it in near-term deposits, you're going to get lower and lower returns. But again, so this is what one would do with kind of safe money is that 4-year corporate, good grade corporate bond. You'll feel good about it. I enjoy even talking about it. So, but in the stock market, there's a tendency of, we've got a good stock market. Yes, we should take some money out, but then people really don't want to go out of the stock market. So then the fund managers buy what they call defensive stocks, and maybe like utilities or something like that. So anyways, these, and I like to quip that you buy a defensive stock because it'll go down slower in a bear market. In a bear market, you just don't want to be overly long. And then, as I say, with the liquidity that you build, you can get a decent return out of some corporate bonds at the 4-year maturity in that range, and you can rest a little happier that way. The old saying about gold in the storm, yeah, that's possible, but you want to have a little bit of gold just as kind of insurance kind of thing. But in the gold stocks, they're going to be up and down with the general stock market. And if the general stock market's going to be probably taking a serious turn to the weakness after mid-year, you don't want to be overweighted in gold stocks either. So it's sort of like all one market. The all one market is overpriced at about the right time, and one should be taking some money off the table and building some liquidity.
Bob, thank you so much for chatting with us.
Very good, and we'll look forward to next week.
My guest has been Bob Hoye, Chief Investment Strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.